Well, hello everyone. Welcome back to the channel. This is Day Trading Features with JD, and I'm JD. All right, so here's part two of the video series. In this video, we'll be talking about recognizing divergences. We'll talk about the divergences that will show reversals or the probability of trend continuance. We'll talk about what they look like, how they're different, and towards the end of the video, I will explain to you the one trick that has helped me understand which divergence I'm seeing and how no one else has explained it in this manner. This has confused me over the time of I've been trading. Is whenever I would see a divergence, I knew it was a divergence, but I didn't know what I was seeing. So I didn't know what action to take based on what I was seeing. All right, so the motivational quote for this presentation is the hard work in trading comes in preparation. The actual process of trading, however, should be effortless. This quote is from Jack Swagger. So that's what we're doing in this video course here, this video series, is that we're working hard to learn trading, to find the things that we're missing in trading to be better traders. That was one of the things, you know, it's kind of like the old saying, we don't know what we don't know. 6 months ago, I thought I was ready to begin. Actually, I guess it was longer than that now. 7, 8 months ago, I thought I was ready to jump right into a funded evaluation program with UProfit. And whenever I started it, I thought I knew everything there was about trading because I had 4 or 5 indicators. My chart looked crazy. And of course, I blew the account within 2 or 3 days. I know I have a lot of beginners watching this video. This course in this video series will help you find the gaps that you're missing. So let's put in the hard work so that we can be better traders. So we're going to start off understanding what are divergences. A divergence is where the price is different from the momentum of an oscillator. A divergence can show you a continuation of a trend or a trend reversal. I would like to add, do not place your trade based only on a divergence. You need a confirmation that either a trend is continuing or that a trend is reversing. So in confluence with price, you need an oscillator that will show a divergence. I don't want to get into all the different indicators on TradingView that will paint a divergence. That will have a little flag come up. Generally, those are lagging. They're not in the moment. But what I will do is show you the different oscillators to use that will help you see it before your oscillator will paint, if you have the settings for it, that will paint the divergence. 3 of the most common ones are RSI, stochastic RSI, and the MACD. And in my whenever I show you the charts and go through some divergences, I will only use the RSI. All right, so the 4 kinds of divergences. When looking for a divergence, I'm going to talk about angles and where the angles are placed. Those are the two main things to look for when you're looking for a divergence. You're going to look for the angles and the placement of the angles. So first, we're going to talk about a trend continuation divergence. It's not a guarantee. If you see this happen, or if you see a trend continuation divergence, there's only a high probability that the trend will continue. You'll need confirmation. The two the two types of trend continuation divergence. They will be titled with the words hidden in front of them. Hidden bearish means that the price is continuing down. A hidden bullish is the price is continuing up. So with the hidden bearish, your price will have lower highs. It means it's going to be in a downtrend. You're in a strong downtrend. Your price has lower highs. Whenever you look at your oscillator, like the RSI, your oscillator is going to have higher highs. The way we find this is by using angles. The angles will be measured from the peaks of the oscillator and the peaks of your price. The angle that will be shown will be the greater than sign, the greater than mathematical sign. Now, when we go and when we're talking about the key tip in understanding with your hidden bearish divergence, your angles are going to be shown at the top, on the top peaks of both your oscillator and of the price action. Now, another thing when we're looking at the hidden bullish, forgive me, my network seems to be running a little slow today. All right, so the hidden bullish, the prices, like if you're in an uptrend, you'll measure the peaks. I'm sorry, you'll measure the valleys, the bottoms, and you'll have higher lows as the trend continues up. But your oscillator is going to show lower lows. This will be the mathematical sign of less than. The thing that you're going to see different is anytime we're talking about bullish, the angles are going to be at the bottom of the price and at the bottom of the oscillators, the valleys. All right, now, again, whenever we're about to have a trend continuance, you're going to see the hidden bullish, and the angles are going to be on the bottom of the valleys. All right, so now let's talk about the reversals. Again, not a guarantee, only a high probability that the price is about to reverse or your trend is about to reverse. Anytime you talk about reversal divergence, you're going to have regular in front of the bearish or bullish, or sometimes they won't even have the word regular. It'll just be it'll just be bearish or bullish. Bearish, of course, is the price going down. Bullish means that the price is going to change and go up. So with a regular bearish, your higher highs are forming like in an uptrend. Your oscillator is going to show lower highs. So it's going to create this less than signal, this less than angle. And anytime you're talking about bearish, your angles are going to be measured from the top, on the top peaks. So if you notice, it's going to look a lot like let me rephrase that, the divergence is going to look very similar to the hidden bullish because we're both showing the less than sign, the less than angle. The difference is anytime you have a bearish divergence, you're going to see these angles at the very top of the price action and the very top of your oscillator. And we're going to go to the regular bullish. If I can get my Google slide here to act right. All right. Okay, now we're talking about the regular bullish. Here you have a price going down. You have lower lows, but your oscillator is showing higher lows. Again, anytime you're dealing with a bullish divergence, you're going to see the angle be at the very bottom, the valleys. With this bullish divergence, you're going to see the greater than sign. And we're going to be measuring from the bottom. And you know that the bullish divergence means that the price is about, or the trend is about to go up, most likely. Key tip in understanding, bullish divergence always show on the bottom valleys. Now, this is the main difference that no one has talked about. It's the type of divergence will depend on the location of the divergence. If it's going to be measured from the top, or which will be the peaks, or the bottom where the valleys are. The bullish angles are always going to be on the bottom, whether it's going to be a bullish, a hidden bullish, which would mean your price is continuing up, or the hidden bullish, which means price is about to go, it's about to reverse from a downtrend to an uptrend. Okay, you're going to see those divergences on the bottom when you're measuring, looking for these angles on the bottom. Your bearish angles are always going to be on top. The hidden bearish and the regular bearish, the angles are always going to be on the top. All right, so let me show you a couple on the chart here. Now I'm on RTY, on Russell 2000 futures. I think I'm going to start trading RTY, because I mean these candles aren't near. Now the price isn't going to move as much, but these candles aren't near as crazy as the ES minis. All right, that'll probably be on another video. All right, so when you're looking for divergence, we're in a downtrend right here, right? We're going down. And all right, get another one here. And of course, we're going to when we're measuring, looking for divergence, we want to find where the lowest lows, right? Because we're looking for this lower trend to reverse, or this downtrend to reverse. And the way we start doing that, I like to look for support and resistance. We're getting pretty close to some support, so I'm looking that we're looking for a reversal pretty soon. So we look at where we had a previous low, and we look here for a new lower low, right? We mark that. Now, we look at our oscillator and get another little trend line here. And we go to that same point where we had the higher low, but on the oscillator, it shows a lower low. All right, from the previous, but the oscillator, sorry, we actually see a higher low on the oscillator. We paint that out. And as you see, we have the greater than sign. That means price is about to reverse into a regular bullish divergence. So we start playing this out. So as you see, that's why you don't want to enter the trade right when we see that divergence. We want to see the, let me pause it. We want to see here where we have the so we start to see a bullish trend reverse, but we want confirmation. And the way we get that confirmation is whenever we have another signal that breaks the trend line. Once you have it open and close, breaking that trend line, it's pretty safe to say that you're in a trend reversal. All right, so I think you guys get it now. Y'all can watch other videos on YouTube where they explain or they show you different, all the different divergences. I just wanted to put this video together to kind of help you explain or help you understand the differences of these divergences and explain it in a way that no one else has. And I hope that you have gathered some new information here, that the bullish angles are always on the bottom and the bearish angles are always on top. So as we go to wrap this video up, if you've already made it this far in the video, that means you've gotten some value out of this video and you've liked this video. And I would appreciate it by giving me a thumbs up. To find more accurate divergences, it's always a good idea to trade on the 10-minute or higher time frame. If you're looking at a 3-minute or a 1-minute time frame and you see a divergence form, it's not going to be a trend reversal. Do not take trades only based on the divergence. You need to watch price action, watch your support and resistance, and then you also need to look for a confirmation. In the next video, I want to talk about that. We're going to talk about the Fibonacci retracement. When we add in support and resistance, when we add in divergences, we're also going to add in the Fibonacci retracement, and this will help you win more trades. And then in the episode 4, we're going to bring it all together, and I'll do some live recording where I add everything I've talked about in this video series and show you how you can be a more profitable trader. So if you think you're ready, if you want to go ahead and jump ahead, and if you want to try out where you can test your skills and trade other people's money, if you're ready for that, you should consider Apex Trader Funding. Apex Trader Funding has a um, uh, very few rules in their evaluation process. I would recommend you to look at this next video that I'll go ahead and put on the end card here, and it talks about a little bit about their program, about their rules. I think it's a great company. Currently, actually right now, from this is as of recording January 22nd, they're going to have this promotion until March where you get 50% off of your evaluation fees, and you use the discount code here, save 50, to have 50% off of your evaluation. Well, that's all I have. I appreciate you watching. If you have any questions, be sure and comment below, and I'll respond to you as soon as I can. Thanks for watching, and stay tuned to the other videos in the video series. Take care.